It was an absolute bloodbath out there today for arguably a variety of reasons, but perhaps the most obvious just being Tesla and Google both gapping down big time on earnings. Now, pair that with PMI missing on both the manufacturing and services expectation, and volatility in the currency markets, there was no hiding anywhere during today's session. Welcome to the Trade Brigade Midweek Market Update. My name is Matt, and I want to show you today the data points that I'm seeing, and more importantly, how we should use them into the end of this week. As always, check out the links listed down below in the description, hit the thumbs up button and subscribe, and stay tuned until the end of today's show. I've got 2 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So let's kick things off with a closer look at the SPY daily time frame chart. What do we see here from a trend perspective? Well, unfortunately, if you're a buyer or a bull in this market, the trend is no longer up on the daily time frame. The current count is as follows. We have highs, and now we have a lower high that's been cemented on the daily time frame chart. The reason I would say that with confidence is because we did attempt an hourly uptrend in here off of what would have been the ideal spot for a daily higher low, right? The top end of the previous balance, which once acted as resistance, tried to act as support, but it was clearly very short-lived, and the icing on the cake is the fact that we already have a lower low on the table based on today's breakdown and expansion of range in the downward direction. So the trend count is as follows in total. Highs, lows, and lower lows were sitting on the lowest low in the trend cycle. If we're thinking about structure, there's a massive gap down on this morning session, which yields a lot of the move to break down underneath that possible higher low, which has now obviously failed. We can see from the daily bar that there's absolutely no upper wick here, so there's no attempt whatsoever from the buyers to close some of the thin structure overhead. There's no attempt to battle for price acceptance inside of the Tuesday range. This is a huge failure. If the buyers did step up here, let's play the theoretical what-if game, and we got some sort of move that looked like this, now we're starting to envision how possibly on the daily time frame chart, this is a double bottom, and over the neckline, we would be targeting back up towards the all-time highs. That's a pipe dream at this point because clearly there was range expansion in the downward direction. The sellers closed incredibly weak down towards the lows of the range. We tagged up to the lower edge of the weekly expected move. We're sitting on the daily 50 SMA. We absolutely crushed this possible area of support at 547. That would have been the top end of the more concentrated value from the daily balance range that we were just referencing, and there was also no support off of the bottom end of that daily balance, and that level would have been at 543.20. We'll see both of those locations on the hourly. There's only one intraday hourly green bar, and it was not supportive over either of those 2 key areas, right? So bears are totally in control here on the daily time frame chart. The trend is now down, and you can also see an increase in volume on today's session. If we're thinking about outcomes moving forward, though, what do we want to be on the lookout for? Well, being a new money short dead on the lows of the move is never really advantageous from a risk-reward perspective. I would say it wouldn't be unreasonable for a counter-trend move to attempt to develop here, and we'll see this with some more detail on the hourly chart in just a moment, but if there is a counter-trend move, any daily lower highs that are set underneath this key inflection point, the top end of the balance, which tried to act as support and has now failed, that level is at 549.50, keeps the daily trend ideally down. We would have highs, possible lower highs forming in this location, coming from the lowest low in the trend count. Equal low would then target the breakdown and the possibility for tagging up to the weekly higher low opportunity at 532.50. So let's talk about the downside here. If we are going to get continuation to the downside, ideally it would just be consolidation here intraday, some sort of breakdown on Friday perhaps. That keeps us underneath this daily balance range, right? But the CPI gap is the next thing to aim for underneath, and this is the CPI cycle from 2 months ago. So that would be underneath 540.30, trades into 537. As an intraday operator, probably willing to put on some risk down there, noting that the intraday structure, hopefully, is respectful of, the gap ranges, generally speaking, are an area where I'm willing to entertain putting risk on through an area where there's virtually no structure, right? So I'd entertain that downside. But for a longer term short trade, I would not be entering huge new money shorts swinging for the fences down on the lows here. Instead, I would say if there's then one of these, aka some sort of inverted head and shoulders, that's where we get the counter trend move on the daily, set a lower high, and then we're ultimately trading back down to the equal low. If the market really goes for broke and is going to say, you know what, we're going straight to the weekly high or low, if this happens into Friday, I would entertain buying opportunities down here for looking at the counter trend move to develop. I would not be a new money short this far extended through the lower bound of the weekly expected move. I would be a buyer at this location for the opportunity of a weekly high or low, as we've just described. Once again, that number is at 532.50. If you want an easier visual just to sort of digest the change in trend here and the substantial, the significance of this change in trend, you could use the trend channel. And if we do something that looks like this, any sort of backtest of that level is a backtest of the support trend line. A lower high there makes a lot of sense. And once again, that level is at 549.50. Let's go ahead and move it on down to the hourly time frame chart. Let's get even more granular. And let's talk about the failure of the Tuesday session in particular. So as the market was pulling back, we know that we could have been looking for a daily high or low over 549.50. And early on in the week, that was actually the right concept, right? You can see that the market did move higher off of this area. But notice into the close of the Tuesday session, there was a lack of ability from the buyers, we'll say, to hold up over the opening print or over this key level, basically, of what could be considered an inverted head and shoulders here on the hourly. So that reversal did not hold up. It started to weaken into the Tuesday afternoon. And you could argue that the reasoning behind that is risk off sort of money coming out of the market to anticipate Tesla and Google earnings, and that's fine. But notice that the gap down takes you directly to the head of the pattern. And then, as we were saying, there's hardly any indication for buyers stepping up at 547. Blip, the one green bar, maybe gets a little bit of buy-side activity off of 543.20, but where do we close? Firmly underneath. So all things considered on the hourly time frame chart, the trend, of course, remains in the downward direction. There's an opportunity for a counter trend move, and any lower highs that are set underneath 549.50 fly. So how are we looking for this to shape up? As we talked about consolidation here, this is an outcome. I would entertain shorts through this zone as a scalp intraday. This is not a swing trade. This is not an, oh my goodness, markets are going to zero. Shorts dead on the lows of the trend, never advantageous for really longer term trade ideas. If we're thinking about counter trend moves, right, something that looks like this, a brigade bolt up and over 543.20, recaptures the bottom end of the balance range, I would entertain longs through the thin structure up towards, again, 547 would be the first test. And if it wants to go beyond that, I would really start thinking about lower high opportunities here up against 549.50. The key question becomes on the hourly time frame chart, Matt, where do we throw all of this bearish activity out the window and change back to being bulls? I would argue you would need to see, and this probably is going to take more than 2 days, right? But something that looks like this maybe starts to indicate that this was a little bit of an overdone reaction to the downside. But as we'll see when we walk through the evidence in today's video, I'm not convinced that this is a higher probability outcome for the S&Ps. We're going to check in on some Fibonacci's coming in from the all-time high down to the most recent low. If we do get the counter trend move, just notice that the 38.2 is perfectly aligned with the top end of the balance range. Once again, that level, 549.50. Anything in the grand scheme of things that is down here is just a bear flag. And you could make the argument, too, that this is a longer run head and shoulders that's starting to develop a right shoulder here. If we bring out the intraday anchored VWAPs, what are we noting from this perspective? Again, 549.50, a lot of confluence. These are going to come barreling down on that particular level as more volume transacts. We noted that on today's session, there was a higher degree of volume. Here is your daily bar volume, right? That's obviously substantially increased from Monday and Tuesday, but even over what we saw from some of the selling pressure into Thursday and Friday of last week. So those anchored VWAPs, volume weighted average prices, will be providing confluence, the more volume that transacts around that 549.50. So this is all adding up in my head to the key areas continuing to describe the shift in tone we've seen here now on the daily chart, which is transposed, of course, to the hourly as well. Let's jump on over to the market internals, and this really is the nail in the coffin. If you had any hope of, this is just a big fake out, I'm not convinced. Check out the video tutorial in the top right-hand corner if you're not familiar with this dashboard. So on today's session, substantial volume outflows flip the flows of the week to also being out. If we look at the advanced decline line, it closes in trend lower zone. There's a massive lower high here underneath the zero mark after trying to get to the zero mark off of the open. If you look at the index score, it built to the downside all day. It didn't stagnate here and get sort of closer to the zero line into the close. No, there was weakness sustained directly into the close. There was no improvement by the time the market was ready to go ding, ding, ding at 4 o'clock. If we look at the cumulative build, it's the same thing. It builds throughout the duration of the day. It's not that this was just a liquidation break. A liquidation break would look like this out of the cumulative build, strong out of the gates with all like huge slams into the negative 1,000, negative 800, negative 750, negative 1,100 or whatever, and then it would wane into the afternoon. That's obviously not the case. So once again, this is not just liquidation break. These are stronger sellers who are actually getting active at the exchange level. The next thing I want to read into here just a little bit is the Tuesday session, because we talked about the attempt on the hourly time frame chart to break out through the neckline and the failure into the close. Well, what was happening at the exchange level on that Tuesday session? When this breakout was trying to take place, we had really neutral volume flows. They did nothing that day. If you look at the advanced decline line, I'll give credit where credit is due. It sort of recovered off of a negative open, but it just clung to the zero line all day. The cumulative build out of the tick also didn't do anything. It was completely flat, and the actual highest read of the day was just a hair over 1,000. Substantial reads are net 5,000, positive or negative, in the direction of the trend. So really not getting a lot of confidence from that Tuesday attempt at the stronger hourly reversal back in the upward direction. Once again, I think that this completely aligns with the fact that we called it a lower high on the daily time frame chart. Let's finish up the ES side of things. I almost slipped and said NASDAQ with the market profile. And if you're not familiar with this dashboard or chart feature, basically, check out the video tutorial in the top right-hand corner. Now, we almost never, I actually can't think of one time we've put a drawing on a market profile chart, but today we break that streak with this yellow line right here. I'm going to highlight it with white, and then I'll clear that up so it stays yellow. That's the point of control from today's session. The orange line, FYI, is the current trade price in the after hours. But what I'm trying to illustrate with this drawing is that the point of control was completely underneath the daily balance area that we were just talking about, completely underneath the more concentrated value outside of the 1 and 2 indications, which actually set the technical top end of the balance, right? So that point of control migrating to the downside is also aligning with the fact that stronger sellers are getting quite active here. If we didn't have stronger sellers, we'll play devil's advocate, you would have seen a point of control and value really remain high in the profile. You wouldn't have seen acceleration to the downside, or if you did see acceleration, it would have been some sort of look below the level, come back up above, and then build out some sort of P-shaped profile, which is always indicative of long liquidation, right? If the value is up here, these are just longs with terrible location closing out. That's not the case. And once again, everything that we just described is aligned with the fact that stronger sellers are finally starting to get active in this market. So long story short, out of the ES here and the S&P 500 is that we want to start selling rips and not buying dips. Let's bring this back to a daily time frame chart, and we'll sort of breeze through the remainder of the market indexes. I know today is a late night episode. What do we see out of the QQQ NASDAQ? So certainly the daily trend has been down here already, with a big time lower low being brought in. We had equal lows to the bottom end of the balance already. And on today's session, we've snapped it in the downward direction. So we didn't really have a do or die moment. We already knew that the NASDAQ was weak. We could also zoom in here and reinforce the idea that Tuesday's lower high is sort of what we're looking for out of the S&P up next. Here is the original balance range. Here's the lower high that's set underneath, and then we look for continuation in the downward direction. You'll notice that we have completely broken through the daily 50 SMA, the blue moving average on the screen, and we've closed at or even slightly below the lower edge of the weekly expected move. So just like the S&P, I'm not convinced that new money shorts are advantageous down here at 465 in the QQQ. And instead, I would be thinking about counter trend moves that now set a daily lower high underneath the bottom of this sort of neckline, if you will, if you wanted to count this as sort of a head and shoulders as follows. Lower highs below the neckline, 475. Today's high of day is 474. Any lower highs in that zone really keep the trend ideally in the downward direction. Just like the S&P increased volume on today's session, if you were to continue in the downward direction, the weekly higher low zone is right there at 459.50. So this is completely, it's the same concept as the S&P, where I would not entertain shorts here, and instead I would be entertaining longs for the counter trend move to see if the daily wants to, or excuse me, the weekly, my apologies, wants to find that higher low opportunity. If it does, it wouldn't be insane to think that the daily could find itself back up at the gap down sort of open from today's session, 475. We just talked about how that's the ideal structural location for that lower high to be produced. If there is continuation, I would sort of let this balloon drift away. There's too much down here. When we have overhead resistance, we call it power lines. We're going to need to come up with something fancy or funny for big support underneath us, but there's too much of like a net of support in this congestion, where I would tend to think that the bulk of the short trade actually happened already through this sort of thin structure. I mean, the CPI gap already closed from the NASDAQ, right? You'll notice that that is completely closed on today's session. And just like the S&P, there was no attempt for support here or support here. Let's take it on down to the hourly. I'll show you that in more detail. So the CPI gap range, if I just zoom back out on this, would have looked like that. And I'm just going to put a line here so we can reference this zoomed in a little bit. Notice the only green bar broke through, found a lower high underneath, and continued in the downward direction. So sellers are definitely here in the QQQ. They've been here, and we've known that much more so than the S&P for a while now. The S&P was hanging on to hope, right? We talked about that do or die moment. But the NASDAQ has been game over with this lower high, at least in terms of flipping to a more severe downtrend for a little while now. If we're thinking about the Tuesday failure, it's the same idea as the S&P 500, so no need to beat that drum, if you will. Let's come back in here with the Fibonacci's, and then I'll give you the pathing. 38.2 is sort of in no man's land in the gap range. I would focus much more on the structure so far. Remember that it's nice when the Fibonacci's align for confluence, but structure always supersedes it in terms of analysis. Then we'll come in with the anchored view apps, and once again, we'll finish off on pathing here for the QQQ. What's going on? Why can I not see any additional bars here? 50 bars of expansion. Why is that not the case? Let's try this out. Thanks for working with me on the fly for this late night episode. One take, we're going to get it done. These anchored view apps will slowly provide confluence with that 475. These are not so much in force. I would argue, if anything, maybe on any sort of like wowzer type of move that's back up here, you could look for a lower high still up against that area, but that's sort of a pipe dream as of right now, a stretch of the imagination considering the weakness that we've seen out of tech today. So what's the pathing, Matt, out of the QQQ NASDAQ 100? Let's just go back to our moving averages, remove those anchored view apps. All right, here we have it. So on the hourly time frame chart, any consolidation down here, I would not entertain for a short. I would look for a rebound off of the weekly high or low. If you want to put your neck out on the line and try to buy it here at the lowest low, be my guest, but the better and higher confidence trade looks something like this over 465. That sort of higher low sets up risk reward for a counter trend move, which, as we know, is just targeting 475, 474, and this is where we would change our tone back to the downside. I'll even bring out a red crayon for this one, where, let's go white crayon first. The rollover up here targets, of course, the equal low, but the risk reward, now we'll go back to the red crayon, looks something like this, where we have risk and reward is trading back in the downward direction, selling into the rip, right? That's basically the concept of what we just described over on the S&P 500. If the market sees a counter trend move without targeting this low first, and it does not offer the Brigade Bolt in here, you're going to have to get a little bit creative. I'm not convinced that you would want to take a higher low over VWAP because we're not making a new 2-day high at that point. It's very difficult to pull off that counter trend move. If anything, what you would look for is just consolidation down here that builds out an intraday range. And if you could break the range, I would argue that that is probably higher confidence than trying to buy a higher low over a VWAP when you're just trading technically inside of the prior day's range. So this structure, if you could build out an opening range down here and then sort of, think about this like squeezing out shorts with terrible location. So you're giving those shorts an opportunity to get involved in the market. And if you squeeze through the top end, they're like, oh my goodness, this is not the place to be short. This is the place to be short. Let's wait until the market gets up towards 475. What do they do to close out their shorts? They buy the market, right? So that's added buying pressure. When we say short squeeze, it's just added buying pressure. So that's the concept and idea here. If you're not seeing this to this, right? It really requires making sure you have the structure and the suggestion that, shorts are squeezing. Short-term short squeeze, right? So that's that. If it's going to continue and it just builds out bearish consolidation down here, then fine. The continuation to the downside is after a day or two of consolidation that then yields the breakdown into probably 453. That's really the daily target that we would have, which comes from the bottom end of this consolidation and where this ultimately stemmed from in the first place. That's the origin of this most recent leg higher out of the market. and that would be that downside target. Again, a bit of a stretch. I would not be thinking about that into the end of this week here. Let's take a look on over at the market internals for the nasty NASDAQ side of things, and what do we see? You'll also note the strong volume outflows closing in trend lower zone and the cumulative build that builds during today's session instead of sort of waning into the afternoon. So all similar indications here on the NASDAQ as we talked about in the S&P. Let's take a look at the NASDAQ futures and see what else we can learn about the activity here. We're going to zoom out on this so we can see a similar indication to the S&P. Obviously, the entirety of the daily range is underneath that sort of overhead balance range. The point of control is actually even lower here out of the NASDAQ market profile. As we zoom in a little bit, notice here's the value area, here's the point of control. It's not like it was left in the midpoint like it was in the S&P 500. So even weaker out of the tech side here. We're not getting a poor high, certainly great excess in A period, great excess in M period. So no reason to sort of believe that we need a sweep and then you could trade for the higher low back in range. There is no poor low. Let's go back on over to the platform. Let's finish up the indexes here with the small caps, going back to a daily time frame chart. What do we see out of the trend on IWM? So obviously, one of these things is not like the other. It continues to be that way. Here's an opportunity for a big time higher low. And we know on the weekly time frame chart, there's really, I would not give up hope on small caps until there's some sort of failure underneath 209.75. If anything, to me, this looks more so like bullish consolidation near these highs. Now, I want to concede the point that, of course, from a more nuanced perspective, you have highs and now lower highs. And if you break down through this, then, of course, it's just a double top. You're through the neckline and a deeper pullback can sort of unfold. But am I throwing in the towel on the long thesis in general? I think not. And some supporting evidence for this comes from some of the components of the small caps, right? KRE, regional banks make up a decent portion of small caps. And notice that there's actually a higher high here. Again, pull back on today's session for sure, but there's technically a higher high. If we look at something like the XBI biotech sector, this is completely outside of and above its breakout point. Yes, it's pulling back, and yes, there's an inverted hammer. Yes, there's a lower high, but as long as you're over 94, pretty tough to throw in the towel on what is currently, from a weekly perspective, an attempt again at a possible breakout. If it looks like this, then I will concede the point. I'll raise my hand and I'll say, you know what? We've probably got to eat our words on the IWM, but so far so good, trying to entertain the opportunity of that higher low above. The one concerning one is the XRT. So here is the retail sector, and it's definitely consolidating over the top end of the range, but you had 1, 2, now 3 technically lower high is forming. Any sort of attempt to these lows feels a little bit heavy for overhead supply to start closing out back inside of that range. Again, we're not there yet, but it's something to consider out of the retail sector. Let's go back on over to the IWM and let's take this back to a daily time frame chart. We know our key inflection point. It's as long as we're over 209.75, sort of good to go. Let's get more granular on the hourly actually and just really see what's going on here. So to me, it's range compression, and it's really not indicative of an overall trend. You've got one of these symmetrical triangles sort of going on. I would argue that the key hold from the hourly perspective is the 218, which we're currently trading above in the post market. The bid-ask spread, I don't know if you guys can see it on your screen, but it's 218.52 by 63. So slightly over that level. And if we can hold that, that would be ideal for the next hourly higher low. It keeps us in this compression, but what's the target? What's the idea? It's thin structure retracement through the breakdown from this afternoon to retarget this area where the breakdown came from in the first place. That's 221.75. If that's taking place, it's probably a higher confidence counter trend idea in the S&P 500 that we're trading for. So really watching 218 out of the IWM. Now, the one concession that it would be irresponsible to not make here is that early on in the session, and if you were watching intraday, you know this darn well, is there was an opening drive to the upside that actually cleared this previous neckline of the double top. Notice that the upper wick of the first hourly bar actually makes a new bar-to-bar, daily bar-to-bar higher high. The failure of buyers to produce consolidation above and then yield some sort of follow-through to the upside into the Thursday or Friday session is somewhat concerning. And again, it's a concession that needs to be made. Is it possible that this just turns into that daily lower high double top? Absolutely. So if 218 is lost, I would sort of prepare for further downside and weakness in the S&Ps. If we can hold it, I would sort of be more open-minded to the counter trend move in the S&P 500. So that's the takeaway from the small caps here. If we look at the Russell internals, I think we'll see a lot of supporting evidence for that whole concept here. Notice the volume inflows on the Tuesday session. Compare Tuesday, I'll just quickly go back to the S&P or the NYSE side. Compare Tuesday's neutrality, and neutrality to what we actually saw out of the Russell here, which had stronger inflows, again, conceding today's selling. I'm not trying to cover that up by any means, but Tuesday was much stronger, right? Tuesday and Tuesday's cumulative build as it was actually breaking in the upward direction on Monday, right? So still, the hopes and dreams are alive in small caps. Let's bring it on over to the Rusty Russell futures and see what's going on with the market profile. This also is very supportive of the concepts we were just outlining. Notice that if I draw a line through what could be considered, this is the hourly double top, this is the daily double top, right? So if I draw a line through the neckline of the original hourly, basically the low over here, notice that the point of control and value area are around that level. They're certainly not migrating to the lows of today's session. They're not firmly underneath that area. They're sort of smack on it. Here's Tuesday's session where the internals were stronger than the NYSE. Point of control and value above that neckline. And here they are on Monday also, when we got that break to the upside. Point of control did validate those higher prices by moving in the upward direction. So I'm liking what I'm seeing here from a market profile perspective as well. Let's move along into our sector analysis for the S&P 500 and see what's going on with the weekly performance of those sectors. So top dog is going to be the XLV healthcare sector. That's the third heaviest weight sector by market cap, but it's also D for defensive. We can see that utilities are green as well. Those are definitely D for defensive, but they are extremely lightweight in terms of weighting. And specifically for today's session, as there's this big breakdown taking place, I would just come back in here as well and say, hey, healthcare, utilities, and the only other outlier, consumer staples, they're all defensive, right? So as this breakdown's taking place, the defensive sectors are getting a little bit of love. That makes total sense to me. It would make sense to me that the laggards of the week so far are the semiconductors, the discretionary sector with Tesla's gap down today, as well as the XLK tech sector. Of course, Microsoft certainly in sympathy to Google, NVIDIA in sympathy to Google, of course, all of these things moving in the downward direction. Not surprised at all. So posture does not strike me as a shocker here. As we take a look at the actual structural elements, the XLV looks great for a break of the balance, holding above. Remember that this looked a little bit scary headed into the early stages of this week, but we gave it the wiggle room on Saturday. You can go back and you can watch the video. I said 147.25. We're back above. So holding above here is bullish because it's the third heaviest weight sector for the broad market, but it's also a little bit more indicative of risk off because it's technically a defensive sector. Let's take a look at utilities. Really more so sideways and stagnating as opposed to breaking out aggressively. And this comes in as a minor indication that it's not totally a risk-off rotation yet, but it's very close, pretty darn close as of right now. The largest laggard, semiconductors, break down through the neckline of the double top 1 and 2. And most importantly, most notably, even if we find a higher low on the weekly off of 237, just like we talked about on the QQQ, NASDAQ, and even the S&Ps, a lower high threat is certainly on the table. The trend has more clearly flipped to the downside out of semiconductors right now. So tone has changed across the market and the really heavyweight components of the risk-on cohort. Let's take a look at consumer discretionary. Tesla's large gap down is doing a lot of the work and heavy lifting here, completely underneath what could be considered maybe head and shoulders up there. But more importantly, the gap down brings us for a close firmly underneath the top end of the prior range. Maybe some sort of higher low is attempted here on like an oversold relief counter trend rally. So keep this in mind as we're going through the heavyweight components, right? Does it look likely that off of the lowest low in the cycle, could we see a counter trend move? I think the answers are yes after these really extreme and fairly substantial follow through gap downs. The lower high could be set anywhere underneath 185.15 and we would have to remain bearish on discretionary for some sort of, look above and fail from the weekly perspective. All right. Not denying the fact that a weekly higher low could technically form, but immediate pressure, how we're going to trade this, probably more bearish than bullish. Same thing here with the XLK. This is going to be a mirror image of the SMH basically. Instead of a double top, it's more of a head and shoulders underneath the neckline. Not a shocker here. Basically looking for sustained follow through into the retest area at 212. If we could spot that and then some sort of reversal, the lower high, I drew that arrow a little bit too aggressively, wants to be anywhere underneath 222. A lower high here keeps the market bearish and will remain in a risk off mode. If we take a look at the XLC, different concept. I would argue that the XLC looks the best. I'm not going to say that it's still in a firm daily uptrend, but the fact that we're still over this 8290 is still somewhat enticing for a stronger weekly higher low even. So this is probably where we're looking for upside out of communications. If that takes place, great. It's at least going to dampen some of the damage over in the S&P if everything else is falling apart. Let's move along to industrials. Big look above and fail on the daily time frame chart, 8% of the S&P 500. So worth noting, technically speaking, the target is always the bottom end of the range. That's bearish for markets. I'd be more concerned on a new swing low underneath this. That's incredibly weak structure at this point at 120.40. A subsequent retest after a failed breakout, I would expect that to go through on a upcoming test. Here's the XLE failing its double bottom neckline, so no brigade bolt over that level. Acceptance underneath on Tuesday and today's Wednesday session is bearish. Moving along to financials, a diamond in the rough, looking pretty darn good here on a break of the balance range, not failing into the balance range. I mean, not the best indication of a daily bar, very weak daily bar, but is it still possible to find a higher low over the top end? Sure. 42.50. If we go through that, is it the end of the world? No. We could still technically respect the neckline of the inverted head and shoulders, looking at 41.75. So keeping hope alive out of financials, and this makes total sense. We know that the tech sector has really spurred the weakness in the broad market as a whole. Materials, nothing to comment on here, midpoint of the balance range. Real estate, looking a little bit more so like a look above and fail. We know that rates moved slightly higher during today's session, but still underneath that 4.33 area. We'll take a look at the TNX in just a moment. And lastly, we've got the XLP. This, of course, look above and fail target, just like the XLI it was, is the bottom end of the range here at 76.25. This is a D for defensive sector. We talked about how it's one of the other green names on today's daily session. It tried for price acceptance inside the Tuesday range. And, again, progress from the buyers much more so than the broad market, but we still didn't see a close in the prior day's range, and it was almost like a gap fill reversal into the afternoon there on that little sort of upper wick that formed at the highs. Anyways, those are the sectors, and again, be thinking about the counter trend move in the heavyweight components here off of the lowest low in the trend sequence. Doesn't mean we're bullish the market, but it means a counter trend move could possibly unfold, which gives us the lower high where we really want to be thinking about that short more aggressively. Let's jump on over to the ratio grid. Not a shocker here, not a shocker here, not a shocker here. This is our larger concern. The XLY was doing a decent amount of work trying to put in those higher lows over a still downward sloping 50 SMA. Today we failed underneath that level. So no longer helping the case for the buyers. The risk-off rotation is becoming more and more of a threat down here. And if we take a look at some specialized ratios, also a threat out of these names. This is a head and shoulders now with a lower high clearly in place. This is clearly underneath the neckline already at 3.2. This is back down underneath and inside of its long-standing balance. And this over here is certainly lower highs and consolidation underneath an upward sloping 50 SMA, indicating a stronger move to the downside. You'd probably only entertain like maybe weekly higher lows, probably monthly higher lows if you're trying to maintain a bullish stance. This ratio, by the way, is SMH-XLV. The thing at the bottom, we have not talked about currencies almost ever on the channel here. However, this is becoming more and more of a phenomenon that's being discussed across many participants. So volatility, and I think that actually the best way to show this is looking at the dollar first, and then we'll change out for the Japanese yen, basically, is what we're about to look at. So dollar does not seem volatile in here, but what about the dollar as expressed in relationship to other currencies? So we'll go USD/JPY, and what you'll see over here is a free fall. Now, this really boils back down to the carry trade, and I'm not going to pretend to be an expert on the carry trade, but the basic premise is, and you can do more research into this, is that investors will borrow Japanese yen at virtually 0% interest rate, because that's how their financial policy is set right now, and it's been for a while, and then they'll go out and they'll buy USD, and what they will do with that is, of course, invest for any yield that is greater than the spread. That looks like a 5, it's an S. They'll invest for anything that's greater than the spread on their borrowing costs, right? That's basically free money from Japan. So if this carry trade is set to unwind based on this breakdown, you would probably want to see it underneath 151.85. It's just something to keep an eye on. When the market's been volatile in the yen specifically, you tend to get a little bit of volatility. This wasn't all that bad in this previous instance, but this certainly was. That sort of brings us directly down to when this sort of uncertainty was taking place during the April pullback, right? So just keeping that in mind. That is what we had on that additional indication there. Let's move on over to the interest rates and see what's going on. We talked about an uptick, right? We saw that with the real estate sector being down. You could probably make the assumption, seeing that the TLT was down on today's session, that rates were probably up, and that is the case. But is it possible you just set a lower high here? This is one of the bullish data points that support the idea of a counter trend move. if you could reject off of 43.33, then great. Maybe that actually alleviates some pressure in equities down below and helps the case for the counter trend move. So if you notice that interest rates are lower tomorrow morning, that would again be a confident data point to say, yep, we're going to be thinking about the counter trend long, not the continuation short. If you're breaking out big time through 43.33, different consideration, of course. Let's take a look at the inverted ZT to get a sense for what's happening with the Fed, and of course continuing to drift in the downward direction. We know that we're pretty much 100% odds of a cut this year, and pretty much spot on for odds in the September timeframe, coming in with a cut. Let's take a look at the tracker tool. Here it is. So unchanged for the month of July. This meeting is happening in the end of the month here at 93.8% odds. But here is the September timeframe. 90% odds, 0% odds for a pause, 9.7 for a double cut, and 0.2 for a triple cut. Yeah, right. So I think that Jerome Powell is likely to entertain this opportunity here, but anything more than that, after today's PMI miss out of services, the risk of bringing inflation back is far too aggressive here. So if we actually look at the calendar and what printed today, notice that your manufacturing PMI missed. The expectation was at 5170, and keep in mind that over 50 is expansion, under 50 is contraction. This is contraction out of manufacturing. So our actual output, our production, no good. It is contracting. It missed the expectations. That would speak to growth possibly slowing down. What about services? Services came in hot. Really hot, 56. The expectation was for 54.70. So what do we know is driving the main component of inflation, right? This is not output, this is not goods, this is services. That is the main component, the main driver of inflation. It's been that way for a while. So watching this and the way that these numbers were reported today, the story that starts to come to mind is the dirty R word, where inflation goes unchecked. Growth stagnates to a point where, oh my goodness, why are things being priced this expensive in the S&P? And we see a larger downdraft out of the equities market. So that's what this starts to suggest to me. And we can sort of dive into this a little bit. I do want to show you an interesting data point here. This is the number of days since the S&P had a decline of 2%. So a long streak before 2007. And if we know our market history, in this area, of course, is when the S&P went through the Great Financial Crisis. I shouldn't say the S&P, but just the U.S. went through the Great Financial Crisis. What about this one, which we are basically on par with? This is where we had Volmageddon. Maybe not Volmageddon, but the Christmas Eve massacre was on, 2019, 2018? Now I feel like I have to double check the work, otherwise I'm going to feel bad for misinforming you. Let's go to a multi-year chart, and we'll look at months. This is on me. This is just a fun midweek episode at this point. So here's the Christmas Eve massacre in 2019. On December 24th, right, half day in the market, that's when things really fell off of a cliff. They rebounded, but that's where this is coming in from. All right, so generally speaking, is this the start of some more volatility out of the market? I certainly think yes, and the data point sort of supports that thesis. As we think about earnings, and I just want to rewind back to the comments about growth, Google actually reported some pretty solid earnings. You can read this for yourself. I'm not going to read it verbatim and sort of go through that, but they reported decent numbers, but it was an expectation issue. It was an expectation issue where analysts were sort of expecting maybe that this AI growth story was going to continue to blow up and balloon into these major numbers, but it actually was just like, no, we're doing all right, but don't expect AI profitability to be through the roof at this point. I think you guys have priced in mostly what we're shooting for. So that's Google. I wouldn't argue that the business is actually doing poorly. I think it was an expectation issue. So that's possibly a bullish counterpoint to some of the more technical analysis that we've been looking at in today's session. If we think about Tesla's earnings call, this was not the case from Tesla. Tesla was looking awful with vehicle sales down. It's not mentioned in this snippet here, but of course, all of the expenditures on AI and their Dojo chip, is that going to be is the juice worth the squeeze, basically, to produce your own chip? We sort of went into this commentary in the morning, and I think investors were like, no, obviously it's not. And there's this large gap down with follow through to the downside, which of course is impacting the broad market. So the story behind Google checks out to me, and the story behind Tesla is like, I don't really think that the Tesla optimism is overly warranted if we're purely looking at it from a fundamental perspective. As we look forward to the remainder of this week after the close today, which is already in the rearview mirror, noting the time here, 10:03, We've got CMG, the world's most expensive burrito, reporting, and we'll take a look at that chart perhaps. Tomorrow before the open, I'd be interested in AbbVie for our healthcare sector. And I would also be interested in BMY, Bristol Myers Squibb, for the healthcare sector. That's before the open on Friday. Let's go ahead and move back on over to the platform to finish up today's analysis with our risk on versus off, risk appetite charts, right? Moving into the TLT ratio to the S&P, I'm going to bring this up as it starts to stagnate and we possibly have concerns. It's not confirmed, but concerns with growth as we walk forward. GDPs tomorrow morning will be somewhat insightful. It's going to be obviously in hindsight, right? If we look at bonds in relationship to themselves, this is interesting to me. The longer run bond relationship is saying, no, not really interested. This is only stagnating here because we know Fed rate cuts are on the way. So I would really use this as a stronger gauge for whether or not duration risk is accepted in equities down below. So the fact that this is curling higher, even as this looks weak, still makes sense to me that risk appetite might be waning a little bit as we're moving higher. If we look at credit spreads, this is interesting to me because they're so divergent. So LQD is technically higher grade, I would argue higher grade, than what we have out of the HYG down below. This is classically referred to as junk. So, why is that discrepancy taking place? I don't entirely know. I would tend to think it's because of the actual contents of the diversified bond basket, but this is corporate grade, should be decent. This is more high yield junk. I would tend to think that this would actually move lower and this would move higher. But anyway, so this one's just a little bit perplexing, and I would argue that the fact that they are divergent probably is an indication and reflection of volatility. So that checks out with the market being sort of to the, stronger to the downside underneath. If we look at the high yield junk in isolation, we can see why it might be doing so well, because clearly here it's got these obvious higher lows, which are building an uptrend, and that's completely a bullish divergence to what we have out of the S&P. But recall that if we just flip these to daily charts, and I know we're sort of traversing some time frames here, I get it, but just remember where we're trading on a relative basis. If you were to just do something like this, back from this high, look at the difference that there is to make up out of these two things. So is it really that divergent? Maybe on the smaller time frames, it's telling us that you wouldn't want to be a new money short dead on the lows, but does it mean that the S&P has to rally to the upside? Probably not, based on what we just explored from the daily perspective. Let's bring it on over to Bitcoin, and you can see we're back in the range. I think that this is a great opportunity for a higher low. Got to see the higher low again to confirm the look below and fail. And if that does take place, great. It's more of a risk on indication for the market. Let's move on over to some breadth now. Breadth actually improved, or is in the process of improving on this week. If we take this to a daily time frame chart, look at this uptick, right? That's Monday, Tuesday, Wednesday today. Doesn't even get as low as the end of last week. So again, a small counter argument, which maybe is supportive of the idea of a counter trend move actually out of equities down below. We could see similar indications. Let's jump the 200R and go to the 50R. Pull back here still has the opportunity to offer a higher low over the 50% mark out of the SPX A50R. Let's move on over to the RSP. This is also a bit of a bullish data point, I would argue. The fact that we're pulling back, yes, there's a failed break up and over the previous high. Ideally, consolidation would have been here for follow through, but as long as we can stay outside of and above this prior range, I think that that's pretty supportive of the counter trend move unfolding in the S&P. I would not want to be aggressively short the weighted S&P, via futures or, SPX or SPY puts if RSP is holding up over 166.25. Why would you want to do that? Doesn't seem to make sense being a short dead on the lows. So that's the RSP. Let's take a look at the QQQE. This is adding up with the NASDAQ completely falling away from its key inflection point. So no major divergence out of the NASDAQ side of things. We'll look at Dow just because it's probably worth looking at when the S&P is a bit more volatile. Midpoint out of transport, still over the top end of the range here out of industrials, probably suggestive that as long as this remains weak here, this could probably come back into range and spend some more time chopping around. So do what you will with that for the S&P, not overly informative. Here's the VIX, completely lit up like a Christmas tree over the 15 handle. That, of course, is not a shocker in here, but it continues to suggest that as long as this is over 15, you probably don't want to start thinking about stronger bottoms being put in until volatility actually cools off. If we look at the VVIX, you'll get the same indication over here on the increased move up and through the 103 handle. You would probably want to see it under 90 if you're going to start thinking about hammering out a bottom in the S&P that's a bit more constructive. And you'll also notice that our volatility futures, while not technically in backwardation, are moving towards backwardation, that zero mark. They're still in a slight contango, but this severe drop off, again, is just indicative of volatility increasing. One-day VIX up and over that 1275 handle. Let's finish up today's episode of the midweek market update. I'm almost like feeling sat back, relaxed. It's late here in the office and got a nice little nightlight going. So late night episode. Let me know if you guys remember the keyword. I haven't said this on an episode in a very long time. So if you know the keyword for a late night episode, drop it down below in the comment section now to let me know that you've made it to the core list, and we'll get the show on the road. Microsoft breaking down for a lower low gap and go on today's session in sympathy to, of course, Google and Tesla both moving lower. If there was going to be a higher low, ideally it would have been here, and this would have yielded some sort of inverted head and shoulders. And you can see instead Tuesday lower high just like the S&P, inverted hammer, and we've closed and smashed underneath the daily 50 as well as prior support. So looking forward, I think it's quite simple. We are looking for continuation via consolidation here, then follow through to the downside. Or on a counter trend move, I would argue, and the hourly chart will help us out with this, I would argue that the lower high wants to be set here. Anywhere underneath 435.75. Something that looks like this is fine, looking for a lower high to back up against the bottom of the mosquito pattern, as we've dubbed it in the pre-market prep. So 435.75 or consolidation under 432.15 yield downside outcomes. If you were to get something that looks like this, I would start thinking more so about neutral activity. A lower low double bottom is only in play, and this is like a pipe dream at this point, if we get a higher low here. One thing that's going to start to come to mind also as we're talking about earnings season is, and this happened last earnings season also, a handful of names, and namely at this point, Google, have sort of set the expectation that AI results are not going to be stellar this quarter. So if Microsoft says anything that's even remotely positive or better than the expectation, is all of the damage priced in on the sympathy move to Google? It's possible, and maybe that brings us back in the upward direction. We're not there yet, and that's, again, something to deal with when earnings actually come out, but it's a thesis to at least entertain as an idea. Next up, Apple. What do we see over here? Ideally, this would have found support more firmly over the 219, but if you actually look at the hourly chart, maybe I gave it away a little bit too early. Afternoon bear flag consolidation underneath. So not loving the Apple structure here. If it is going to bring some sort of brigade bolt into play, I would entertain longs over 219 for a counter trend move. At this point, any lower highs set below 224, rock and roll, the trend is down. Right? We had talked about this big flush point. Today was payday. So awesome trade here. Brigade Bolt is really the next watch over 219 for a lower high counter trend to be set. If it continues to the downside, it feels a little bit chasey to me at this point. This was the main structure that we were looking to exploit. Down in here, we have a lot more balance and congestion to deal with. Let's move along to NVIDIA. The one stock to rule them all is, of course, on the daily time frame chart. Double top, 1 and 2. Neckline underneath gave us the breakdown today. Not a shocker considering the weakness out of the tech cohort. Notice the clean intraday activity, right? So gap down, lower high underneath, continuation to the downside. Beautiful, love to see it. And it's still in play for further downside. So this is day one of the breakdown. I would be thinking about consolidation that continues into some of this structure from back here at 110.15 and 107.25, or a lower high that suggests continued selling pressure underneath the major flush point here at 118 is also another spot to look for a new money short out of NVIDIA. The only time I would think long here is on a brigade bolt, which starts to suggest look below and fail. Maybe inverted head and shoulders higher low would be over 118. Next up, we have Google, the stock to report earnings and kill the market. What do we see? So large gap down. We've really got to go to the daily chart to reevaluate and reassess what's happening here. So earnings gap overhead is something to be mindful of. Notice the closure underneath the previous structure and balance range from back here, which we broke out of. That's a failure. So going forward, any lower highs set below 174.25 keep the bearish pressure on, and we're thinking about equal lows down into 166.15. If you start to see some acceptance that looks like this into the gap, again, we're trading it, but simply because it's a gap range and the frameworks to trade a gap are very straightforward, right? You know where your location is, you know where your stops and your target are, so we will entertain that. When we get here, probably thinking about just a lower high, right? So one step at a time, but probably still bearish here out of Google. Amazon, what do we see? Big time head and shoulders on the daily, flat stapler top. There is your sort of right shoulder. Neckline flush is the name of the game into the end of the week here. So 180, 150 as long as we're below, leaning on bearish outcomes. If we're above, let it be. And I would only treat this as a double bottom when we're back over this 188.25, excuse me. If we could brigade bolt over that, might entertain some longs, but not thrilled about the structure that's here. Metaverse, what's going on with Zuckerberg's Fantasyland? Equal lows, equal lows. Are we going to get a rinse and repeat? We'll find out. So overall, the gap down was detrimental because what it did is it negated the opportunity for the brigade bolt back over the previous structure, right? This would have been a reversal if you could have caught it here for a higher low. Off the table via today's gap down, and currently looking for another equal low flush point. If we can rotate through some of this, there's some minute structure down here at 455.20, 453, but the main target is this breakout point at 445.50. Thinking about shorts here out of Metaverse if we are under 462 for continuation. On the hourly time frame chart, what you'll notice also a lot about a lot of these names is, barring Apple. Apple is, I think, maybe the only one. There's not a lot of Stevie Wonders that have set up here. This was a sustained downtrend through the duration of the day. We don't have this long-standing balance where we can take advantage of shorts with terrible location. So understanding that, it probably requires a new lower low with a higher low above to form an hourly inverted head and shoulders if you're looking for the counter trend, if you're looking for some interaction off of the gap. It would require this, right? Sweep the low, show me that the sellers fail and are maybe need a breather. I wouldn't call it a failure because obviously the daily trend is down, but show me they need a breather and then look for that upside if you're trying to trade the counter trend. Here's Tesla. Big gap down outside of the balance range up here. Through some of the thin structure, I think things are fairly interesting. Consolidation in this earnings gap range that yields follow through to the downside. Major target is just at 201. It's something to think about here from the, really where it got explosive off of the parabolic move to the upside. That's the upside. The downside to the upside. The upside in the range, it's just got to be about the earnings gap, and I would still be mindful of the 234.15 bottom end of the overhead balance. If you start to get into the gap, there's probably a trade that can unfold from a point A to a point B right here, but don't overstay your welcome at that 234.15. I think that the overhead supply is heavy enough to weigh on prices to yield some sort of lower high. Next up, JP Morgan. We can see here the failure back down into the lower balance range from this area. So name of the game, lower highs, and that's underneath 209.50, by the way. Targets the opposing end of the balance at 204.25. Maybe a blip of something going on here at 207, but namely the bottom end of the range is the target. And we know that financials are technically doing okay on the sector level. So if JP Morgan gives us the look below and fail, I'm long all day long at 209.50 if we can spot the higher low above, and maybe even thinking about holding on to, instead of trimming like 3/4, which would be typical if you're going counter trend to the broad market. If the XLF sector is also trying to yield a higher low, I might be willing to hold on to a full half of the position, trying to get some thin structure retracement overhead. So that's an idea and sort of a management tactic as well that I'd be willing to entertain because of the sector level strength. Really, the damage done to the sector almost wholly comes from Visa's gap down and the sympathy move that happened in MasterCard as well over here. Anyways, let's get back on over to the core list. Netflix, nothing but a volatile mess here. The daily chart is definitely bearish with the upper wick rejecting this overhead range. Thinking about downside, honestly, like just continuing to use this as overhead supply. Earnings was volatile, but still rejected it. This is a lower high underneath the 50 SMA. Under these lows, just continues to bring us down to those next targets, 607.60. Pretty sloppy on the hourly chart. There's not much to really glean here other than sustained lower highs under 641.50. Keep that trade in play, right? You'll notice on today's session, tried to get in, sort of rejected. So this inverted brigade bolt, if you will, is what we're looking for in the downward direction. Next up, last but not least for the core list, then I do have two trade ideas for you, is going to be AMD. What do we see out of AM Dizzle? Here's this overhead range, lower high at the bottom of it basically, failed the daily 200 SMA and dropped like a rock. So all things considered, I was honestly a little bit more optimistic. If we go to the hourly, there was a beautiful inverted head and shoulders. I would have preferred to see this actually play out in the upward direction to set a more firm lower high, but we got to deal the cards that were dealt. So considering what we have on the screen in front of us, I think maybe some continuation into these lows, 143.25 is possible, but I wouldn't be a new money short dead on the lows here, just like we wouldn't be on the S&P. I think the same concept. Generally speaking on the daily chart also, this is a major area, right? Notice found buyers, tried to make a counter trend. Will we find buyers here? Something to think about. So a little bit of extension on like a 5-minute chart. A 15-minute chart, maybe 143.25, but really looking for the counter trend move back higher. Think about the wall-to-wall move, top straight to the lows, right? So that is AMD, and I would be definitely entertaining stronger shorts, but only after either consolidation here for another like more explosive leg out of this thing. But just chasing it on the lows, it feels to me, again, exactly as we've said, sort of chasey. All right, let's move along to the two ideas. First up is Amgen. And I got to say shout out to G in the chat, AMGN, if I could spell. That's how late it is. It's 10:18. It's not that late. Amgen, G in the chat was who brought this to our attention, and the healthcare sector, as we noted, is also holding up quite well. So bull flag happening up here. Earnings are a little bit further out, not really a concern just yet. Over 336, it's blue sky territories. Here it is on the hourly time frame chart. Just a nice little balance range that's formed. I would say that this trade is in play as long as we're over 329. You guys know the rules. Round numbers only up here in the penthouse. If we can consolidate and break, great. I'm all aboard the long train, blue sky territories. Keep in mind, out of Amgen, the options volume here is pathetic, right? So to be kind, it would be to call it pathetic. So maybe be cautious if you are using options. Let's see if the monthlies maybe have some more volume. Yeah, a bit more open interest on the monthly. So be selective with your options that you select if you're going to trade this via options. If not, you could just trade shares. I mean, shares of something this price point, you don't need a ton of shares here to do a decent amount of damage. 5 points on 100 shares, there's your $500 or whatever, and scale from there. All right. So anyways, Amgen, watching this over the 336. That is worth watching. SMCI, let's take a look at Supermicro. This is a big short trade, and you might be like, Matt, didn't you just say out of AMD it's not a short? Well, the reason I like this one better is because we're on the lows already, and there's virtually nothing underneath us, whereas in AMD, we actually have quite a bit of support underneath us. So take a look at SMCI. Look at this activity here. This is AI Mania 2.0, right? Where it's just completely unhinged. Up, 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 up. This thing is nonstop. Everybody feels like, it's unstoppable out of the Supermicro. So if we can flush this, think about how many disappointed longs who finally bought in. Oh my God, it's euphoric. We're making new highs. I guess I'll get involved. Oh, I'll buy the dip. It's got to go back up, right? Oh, I'll buy the dip again. I'll buy the dip. I'll buy this consolidation. If you break 708, how many hearts are going to be broken from this overhead supply? I think quite a bit. So I'm really interested in this thin structure retracement. I'm not going to set it up where oh my goodness, I've put half my account value into this massive trade. I think that the range is going to be fairly expansive if a breakdown ensues and there's sort of a growth concern out of the tech side of things. So I'm really interested in the breakdown here, but I want to be selective about how we manage risk around it. So probably starting with small size positions here. I don't oftentimes swing trade. You guys know that, especially if you've been tuned into the pre-market preps or if you've had conversations, right? You guys know that I very rarely hold things overnight. SMCI longer run puts, if this starts to break down and shows me what I'm looking for under 708, this would be something that personally, and I'm just sort of vocalizing this as a vote of confidence for the idea, this would be something that I might put on some longer dated options and just see what happens with them because of this sort of heartbreak, I believe, that could unfold underneath the 708. So I don't want to be the dark horse betting against AI, but I think from a technical perspective, the trade makes total sense here, especially as we noted, if there are concerns about growth. All right, that is going to do it for today's episode of the Late Night Midweek Market Update. If you enjoyed the episode, let me know down below in the comments section or via a nice thumbs up. Remember also, if you know the keyword for a late night episode, drop it down below in the comments section. We haven't used that in a very long time. I'd love to see it come back with a vengeance. That's going to do it for me. I wish you all a green trading week, and I will see you in the next one.